Hi everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we've got Plexus Corp, and let me tell you, it looks like they might have some interesting things to celebrate or perhaps to explain for the quarter ending June 2025. Get ready because we're diving deep into Plexus Corp's financial performance, uncovering the key numbers and what they truly mean for the company's future. Alright, first things first, Plexus Corp is reporting for the quarterly period ended June 28, 2025. This is their regular check-in with the SEC, and we're going to focus on the juicy bits, especially those financial tables that tell the real story. When we look at the condensed consolidated statements of comprehensive income, the first thing that jumps out is net sales. For the 3 months that ended in June 2025, Plexus brought in over $1 billion, 1,018,000 to be exact. That's a nice jump up from the $960,751,000 they made in the same period last year. For the first 9 months of 2025, sales are up to reaching 2,000 to be exact. That's a nice jump up from the $958,000 nice. Jump up from the $960,758 and $600,051,000 they made in the same period last year. For the first 9 months of 2025, sales are up to reaching $2,907,258,000 in the previous year. So business is generally growing. Now, what about how much they actually make after paying for the cost to create their products? That's gross profit. In June 2025, they reported a gross profit of $103,288,000. This is a healthy increase from $94,415,000 to, better yet, their gross margin, which is gross profit as a percentage of sales, went from 9.8% to 10.1% for the quarter, and from 9.8% to 10.1% for the quarter, and from 9.3% to 10.1% for the quarter, and from 9.8% to 10.1% for the quarter, and $407 in the same period last year. For the 9-month period, gross profit also saw a significant leap. From $2.7 per Faunted Bozol saw a significant leap from $2.7 and to $30,060 to 9.8% to 10.1% for the water, and from 9 period gross profit also saw a significant leap. From $2,000 and to $31,000 for the 9-month period, gross profit also saw a significant leap. Moving down, we see operating income. This tells us how much profit they make from their core business operations before considering interest, taxes, and other non-operational items. For the quarter ended June 2025, operating income was $53,600 on $249,249,249,249,249,249,200 and from $139,000 to operating $9,000 to 5.3% for the quarter and $49,249,249 and to operating $9,249,249,249,000 to $4,000 to 29% to 5.3% for the quarter and 3.9% to 5.0% for the quarter and 3.9% to 5.0% for the 9 months. This improvement in operating income is really driven by that better gross profit and, importantly, a reduction in restructuring and other charges. They spent much less on those one-off costs compared to last year. Let's switch gears and look at the balance sheet, which is like a snapshot of everything the company owns and owes at a specific point in time. First, let's check out inventories. As of June 28, 2025, they had 1,278 cows and 219,000 worth of inventory. Last year, it was 1,311,000 worth of inventory. Last year, it was $1,311 and 430. We are increasing sales, which is generally a positive sign indicating better inventory management. On the other side of the coin, we have accounts payable, which is what they owe to their suppliers. This number is pretty significant at $722,270,000 as of June 2025, up from $606,378,000 in September 2024. This increase might be linked to managing their supply chain and paying suppliers on time given the sales growth. Looking at shareholders' equity, it's interesting to see the number of common stock shares outstanding. It's around 26,985,000 as of June 2025. They've actually repurchased some shares, which can be a good sign if the company believes its stock is undervalued, or it can be a way to boost earnings per share. Now we move to the statement of cash flows, which tracks where the company's cash came from and where it went. For the 9 months that ended in June 2025, Plexus generated $117,213 from its operating activities. This is lower than the $216,371 $1,000 generated in the same period last year. The report explains this is largely due to changes in working capital like inventory and customer payments, even though net income itself was up. It's a bit of a mixed signal. They earned more profit but had less cash from operations, primarily due to how they managed their inventories and received payments. In terms of investing activities, they spent $60,853,000 for property, plant, and equipment in the 9 months ending June 2025. This is a decrease from the $68,745,000 spent in the prior year, suggesting they might be being a bit more cautious with capital expenditures or perhaps have completed some major investment cycles. Financing activities show another increase in cash used, going from $134,305,000 in the 9 months of 2024 to $168,282,000 in 2025. A big chunk of this outflow was the repayment of $100 million in senior notes that matured in June 2025. They are actively managing their debt, which can be good for long-term financial health. Speaking of debt, let's look at note 3. The company had total debt obligations of about $147 million in June 2025, down from about $247 million in September 2024. The big news here is they repaid their 4.05% senior notes that matured in June 2025. This reduces their overall debt and interest payments. Note 4 talks about derivatives and fair value measurements. Plexus uses these to manage risks, particularly with foreign currency. They have foreign currency forward contracts that act as cash flow hedges, meaning they're trying to lock in exchange rates for future transactions. They reported quite a bit of value in these derivatives, with assets of over $10 million in hedging instruments and another $2.5 million in hedging instruments. This shows an active effort to manage financial risks associated with their global operations. Now, let's dive into how the company is performing across its different regions, as detailed in Note 10 on reportable segments. They break it down into AMA, Americas, APAC, Asia Pacific, and MEA, Europe, Middle East, and Africa. The APAC region is really driving growth, with net sales there increasing by a significant 13.9% for the quarter and a strong 12.0% for the 9 months. Operating income in APAC also saw a healthy boost, up $8.5 million for the quarter and a substantial $28.5 million for the 9 months. It seems their strategy in the Asia Pacific region is paying off handsomely. On the other hand, the EM region experienced a decline. Net sales dropped by 14.3% for the quarter and a notable 21.7% for the 9 months. Operating income in ME also fell, largely due to these lower sales. This suggests they might be facing some headwinds or strategic challenges in that particular part of the world. Looking at sales by market sector, their aerospace defense sector saw modest growth, with net sales increasing by 3.2% for the quarter and a slight decrease of 0.1% for the 9 months. The healthcare life sciences sector, however, showed much stronger performance, with sales up 10.6% for the quarter and a slight decrease of 0.2% for the 9 months. It's really encouraging to see the reduction in restructuring and other charges net. For the quarter ended June 2025, it was zero, a huge improvement from $9.2 million in the prior year. For the 9 months, these charges were $4.7 million, a significant decrease from $20.3 million, a significant decrease from $20.3 to workforce reductions or facility changes are impacting their bottom line, allowing their core business performance to shine through. Dollar line, allowing their core business performance to shine through. Finally, let's talk about free cash flow, or FCF. This is the cash that's left over after a company pays for its operations and capital expenditures. For the 9 months ending June 2025, Plexus reported FCF of $56.8 million. This is a considerable drop from the $47 VVF MD and Ekfint al. Amend, well conservated in the same period last year. While they are still generating positive free cash flow, this decrease is mainly driven by a less favourable movement in working capital accounts, even though their net income increased. It indicates that despite being more profitable, they are using more cash to manage their day-to-day operations and growth. So what's the big picture here, Plexus Corp? Is showing solid growth in revenue and profit, especially in key areas like the UPAC region and the healthcare life sciences sector. They've also done a good job reducing those costly restructuring charges. However, the dip in cash flow from operations and free cash flow is something to watch closely. It suggests that while profitability is improving, the actual cash generation might be facing some short-term pressures, possibly tied to how they're managing inventory and customer payments in this evolving economic climate. The decrease in debt is a positive step for financial stability. Overall, it looks like a company navigating growth and managing its finances, but the cash flow trend warrants attention to see if it's a temporary blip or a more persistent issue. That's our deep dive into Plexus Corp's latest financial report. What are your thoughts on these numbers and what they signify for the company's future? Let us know in the comments below. If you found this analysis helpful, give it a thumbs up and subscribe for more decode sessions like this one. Don't forget to join our Discord community linked in the description for more real-time discussions and insights. Thanks for watching, and we'll see you on the next decode.